Charting. Everyone wants to learn how to chart stocks, so let's get right into today's Charting Made Simple class. I'm Matt, Director of Education at Pennybois University, and welcome to class number 6 of Pennybois University LITE. Make sure to check the description in this video for the handout as well as the class video game. Before we start, let me just say that technical analysis is not a crystal ball, it's more like a weather forecast. You cannot predict the future, but you can have an idea of what's coming. Technical analysis is interpreting trends and important price levels by analyzing statistics generated by the past activity of an asset, such as past prices and volume. It's like trying to predict the weather by looking at yesterday's forecast. Just like the weather, the stock market can be unpredictable. But with technical analysis, we can try to at least identify patterns and make educated guesses. How are these statistics formed? Well, the same way that stats are formed in baseball or any sport, using math to track the past. In baseball, you have batting average and slugging percentage. Well, in trading, you have RSI and moving averages. So let's start with the RSI, or Relative Strength Index, which is a momentum indicator that compares the size of recent gains to recent losses in an attempt to determine overbought and oversold conditions of an asset. It ranges between 0 and 100. Generally, an RSI above 70 is considered overbought, and an RSI below 30 is considered oversold. Let's say you're looking at a stock's chart and the RSI is at 90, so you decide not to buy it because the stock is considered overbought. This would be like when you see a shirt in the mall that's $20 more expensive than it was last week, so you decide to wait for a sale. Next up is moving averages, which are a very popular indicator in charting that helps smooth out fluctuations or noise in a stock's price action, meaning it helps you look past the sharp moves up and down so that you can see the big picture. So let's say you have a field of apple trees and you picked apples each day for the past 100 days, and you have 200 apples. That means you average 2 apples per day for the past 100 days. But let's say that out of those 200 apples, half of them, so 100 of them, were picked during the past 20 days. That means you picked 100 apples in 20 days, meaning an average of 5 apples per day. Your 20-day average is 5 apples per day, and your 100-day average is 2 apples per day. Because your 20-day average is higher than your 100-day average, one can assume that apple production in your apple field has been going up recently and is on an uptrend. In the same sense, if you're looking at a stock's chart and the 20-day moving average is above the 100-day moving average, that could mean the stock is also on an uptrend. There is the simple moving average, SMA, and the exponential moving average, the EMA, which gives more weight to recent data. These are just 2 of the many indicators out there. No one indicator should be used alone, as they can't predict the future. If you enjoyed this Pennybois University LITE class, be sure to check out our Pennybois University free Charting 101 class in the Discord, and then ask about our Pennybois University Premium Charting 102 class while you're there. We also have weekly live education seminars and classes. I hope to see you there, but until then, I hope that you all make some bread.